All right, what is up, traders? What's up, tycoons? Super excited for today's video. We have to break down the stock market, okay, and talk about what's been happening in the market and really dive underneath the hood, as I like to say, of what's happening. Now, we just got a 2 sigma move in the S&P 500. We'll explain what that is. It's very, very rare. And we're going to break that down in today's video. We're also going to show how, we're seeing a broad-based rally this week. Okay. If you take a look at the Magnificent Seven versus the rest of the market, that's what we're seeing. However you want to look at it, right? If you look at the equal weight S&P, you look at the equal weight NASDAQ, we are seeing a rally through, the broad base of the market. And the big question everybody has is, will this lead to the end of year rally for seasonality, right? So we're going to take a look at a few of those things. And there were many buy signals, right? And different indicators that we could potentially be seeing some bullishness, right? This is one of them. This is another one using TLT as a leading indicator, using the tips as a leading indicator. You can also use credit spreads, the skew. All right. And then we really need to see to tell whether a move is justified, right? And whether it's a real move, whether it's a bullish move or a bearish move. You need to really dive into some of the metrics of the market and see, are we defensive right now or are we offensive, right? So there's one way you can do that. This is another chart that I like to do that with. And defensive versus offensive is also, kind of another form of saying risk on versus risk off, right? So we have a risk on ETF that I made, a risk off ETF that I made here. We'll dive into all of this to really explain what it is that we need to see a, sustained rally, rather than perhaps is this just a dead cat bounce and maybe potentially we're heading down to new lows. There's also the Dow transportation theory. We'll break that down in today's video. So really, really great information. And stuff you're really not going to find anywhere else on YouTube. So be sure to smash that like button, subscribe to the channel if you guys are new. As always, though, the content on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So be sure to read through the disclaimer. I did start a completely free newsletter for you guys called Investment Intelligence. There's a link in the description, right? Giving out free, valuable finance content as well as free trade ideas. I try to sprinkle in 1 or 2 trade ideas every single week for you guys, highlighting the conditions that we're looking at on the chart. You can see this trade played out very nicely. We also talked about, basically 2 months ago, shorting the home builders, XHB, ETF, home builders, different home builder stocks. That ended up dropping about 18% in the middle of this correction. So not all trade ideas are longs. There are shorts. This was another short on SWK, Stanley Black & Decker, highlighting the rising wedge, targeting where we think the stock could come down. And it literally played out perfectly. So if you're fans of free, valuable content and free trade ideas, go ahead and sign up for that newsletter using the link in the description. And you can also join the Investment Intelligence Discord. There's a link in the description for that as well. This way you can get full access to all of the trade ideas, not just 1 or 2 a week, but, no pressure. All right. Now, what's really amazing too is that in the Discord, everything that I'm showing you right now and much, much more is actually included for you guys. So I've done all the hard work and made all of these charts. And with Thinkorswim, you can actually share flexible grids. Thinkorswim is completely free to use. So everything that we cover in today's video is actually going to be available for all the members of the Discord, simply by joining the Discord, going to the flexible grids tab, and from there you can select all of the different flexible grids that I have available to share for you guys. We've also got some custom scripts and some scans that I'm continuing to add to, as I just started the Discord, right around a month ago. Okay. Also, I have my Ko-Fi page. All right. Ko-Fi is where you guys can directly request a YouTube video on the topic of your choice. You can book your one-on-one session with me if you guys ever want to book, a 30-minute or 1-hour session. Ko-Fi is going to be the platform to do that now. And then you can also click on this buy a coffee button. If you ever feel like leaving a tip, basically, or a donation for the free valuable content I put out for you guys. Now, let's go ahead and get into the video and let's talk about this 2 sigma move. The first thing that I want to highlight here initially is that we did have a 3 white soldiers pattern here. Okay. This is a candlestick pattern, these 3 specific candles right here. And this is actually a bullish candlestick pattern. And as the day was progressing yesterday, I mentioned in the Discord, hey, if we're able to get a strong green body close on this candle, that could end up turning into a 3 white soldiers chart pattern. which could lead to further bullishness in the market. And this yellow line here is actually the 200-day simple moving average. You can see we gapped right up above the 200-day simple moving average and found resistance here up near our anchored VWAP, our 2 sigma move level, as well as our dark pool levels, and above the 0 gamma level. So we're actually in positive gamma territory right now. This actually is one of the flexible grids, right? So all of the dark pool levels, okay, are charted for you guys. The weekly expected moves, the 2 sigma move. So a double sigma move is basically twice the expected move, right? So here's where, the market was going to be opening, okay, right around here. And so the expected move was this right here, right? All in this shaded box in the weekly expected move. And we actually doubled the weekly expected move. Now, around 70% of the time, roughly, you're going to close inside of this weekly expected move. But early on in the Discord, I mentioned, hey, we have the most amount of stocks. This is the biggest S&P 500 earnings week. On top of that, we have binary events besides earnings, such as Jerome Powell, lots of economic data coming out. And all of this was setting up for a recipe for a 2 sigma move to the upside or to the downside. So we were already kind of prepared for this mentally heading into this, right? And I update these, flexible grids right here, all right, with the gamma levels, your call walls, your put walls, your expected moves, your dark pool levels, your max pain levels. I try to update that every weekend, okay? So that way you guys can click on the new flexible grid and you'll have the same exact chart right here that you can click on and have access to for the S&P 500. Now, how did we know that we were potentially going to get a rally after such a brutal past couple weeks in the market? We'll dive into that a little bit more, but what I wanted to share with you guys was how we're seeing a broad-based rally right now. Okay, so we have the Magnificent Seven up here in red, and then we have the S&P minus the basically the other 493 stocks in the S&P 500 in white here. Okay, now you can see how close this was to its October lows. Versus the S&P is up significantly from those October lows, but you can see we're getting a broad-based rally right now. Okay, over here where we were getting this strong bounce in the Magnificent Seven, we weren't seeing confluence here in the rest of the S&P 500 stocks, and this time we're seeing that, right? So not only is the Magnificent Seven rallying, we have the other stocks rallying here too, right? And so that's one way to measure it. Another way is to look at the equal weight S&P. So you have the RSP right here. This is your equal weight S&P 500 index. These are weekly charts that we're looking at. So you can see the progress up in the equal weight as well as the progress up in the actual S&P 500. Same thing with the equal weight NASDAQ up here on top. We're seeing progress and confluence, broad-based rally in the equal weight NASDAQ as well, compared to just the regular NASDAQ. Now, this is seasonality, okay? And a lot of people have been calling for this end of year rally. There's lots of different types of seasonality. Pre-election year seasonality, end of year rally seasonality. We were not going to dive into all of those things. Okay, there's even the November to April seasonality. Historically, those are the 6 most bullish months of the year. Basically, those are the most bullish 6-month time period, right? Actually, because it's between 2 years. So we'll see if that plays out. Okay, election years historically aren't the greatest years, when it comes to seasonality, but it's been aligning pretty well, right? You start off the year with some new highs, then you get that pullback, right? We have the projection here, seasonality on the bottom, and then the actual S&P right here up on the top. And it's been following it very well. Sometimes it gets ahead of itself, right? And it makes new highs a little bit too early. And here we're seeing a more aggressive pullback, continuing to pull back when we were expecting the S&P to start, bottoming earlier in October. We may have finally put in the bottom though. That's the big question right now. So will we actually be able to come in and put new highs as seasonality suggests? That's something that we will have to see, right? There's still a lot of room for us to rally to the upside to really get, to making new highs in the S&P 500. So how can we figure out some of these different signals to let us know when the market is about to turn? Well, one really great one is to look at the percentage of stocks above their 50-day and 200-day moving average. So we have the S&P 500 here on top. Then we have the percentage of stocks above their 200-day moving average in the middle, and the percentage of stocks above their 50-day moving average here on the bottom. Now, if you take a look, this went down to below 10% recently. Okay, so this literally means that less than 10% of stocks in the S&P 500 are trading below their 50-day moving average. This is extremely bearish, right? And these are some of the metrics that people speak of when they talk about market breadth. All right, and so we're seeing the breadth is looking terrible, right? It looks really, really bad. But oftentimes, if you look historically, when the percentage of stocks trading above their above their 50-day moving average is below 10%, when it comes down to that 11% level and lower, that's usually a good time to buy, right? I mean, we're seeing extreme oversold conditions, all right, and you're basically getting a washout in the market. And then what do you get? Well, oftentimes you end up getting that rally. You can also use it to spot divergences. So if you take a look, we have a low here and a lower low on the S&P 500, but on the percentage of stocks trading above their 50-day moving average, we had a low and then we had a higher low. So we actually had a positive divergence right there. And that was a key indicator that the market could be due for a rally. Now, this stuff may seem like a lot. It may seem like it's overwhelming. All right. But the key is, once you just start to get used to these things, it gets very easy to just quickly scroll through these things. And as I mentioned before, a lot of the hard work is done by me. And so if you actually do have a life and things to do, the hard work is done. And you guys can simply just click on the flexible grids in the Discord, and these charts will already be pulled up for you. And you can come in here and just scroll through them, take 10-15 minutes out of your day and take a look at some of the different areas of market breadth and look for any signals that, hey, maybe things should be rallying, maybe things could be due for a drop. So we already broke down the percentage of stocks above their moving averages. We have TLT up top, S&P 500 on the bottom. TLT oftentimes is a leading indicator for the market. And what do I mean by that? Well, if you take a look here, when the S&P was making these higher highs, the TLT was making lower highs. So TLT has a negative divergence to the stock market here. That's an indicator that the stock market may be due for a little bit of a correction, right? And sure enough, we do get that correction. Same thing over here, higher highs, lower highs. Maybe the stock market could be due for a correction, right? I mean, based off of TLT, if it's a leading indicator, and sure enough, we get that correction. And we've seen it multiple times. Most recently, in the last video, I pointed out that TLT was making higher lows while the S&P 500 was making lower lows, right? So we're seeing a positive divergence in the TLT, possibly an indicator that the stock market was due for a bounce, right? So now we have two things saying that the stock market could potentially be due for a bounce. This is TIPS right here, okay? So this is your Treasury inflation protected securities. And then you have the NASDAQ 100 index on the bottom. Okay, so you use TLT for the S&P and use the TIPS for the NASDAQ. All right, same thing, divergences, indicator that it's a leading indicator. Maybe the NASDAQ's due for a pullback. And same thing we saw, we were making higher lows here on the TIPS, okay? And we're making lower lows here on the NASDAQ, indicator that potentially we're due for a rally. So now we have three things, right? And if we're analyzing this stuff over the weekend, we coming into the week saying, hey, the market could be due for a bounce, right? This is credit spreads, all right? Credit spreads can also be a leading indicator. There's oftentimes where you see these divergences. And, basically we're seeing credit spreads go down, S&P go up, right? Indicator that, hey, maybe the S&P is due for a pullback, right? You can see these oftentimes here, same thing, lower highs, higher highs, S&P could be due for a pullback. There's not any divergences here clearly at the moment. We were due for a pullback based off of this latest divergence here. So we'll see, we'll keep an eye on this and monitor this, right? So we've got three signals now. A fourth one, okay, is the skew, all right? So you have your skew index here on the top. You have the S&P 500 here on the bottom. Historically, when the skew gets down below 115, that is a really good buy time, okay? That is where you start to see, some signs of market bottoms and different things like that. Those are really good buying opportunities. And, once it gets above this 146.5 level, all right, those are times when you may want to sell, right, or hedge yourself for the short term. Oftentimes when you're at these elevated levels, you'll see pullbacks in the market. And so, basically these two kind of follow each other, right? So you're going to see the skew go up. You're going to see the S&P go up. As the skew goes down, you're going to see the S&P go down. And we basically talked about how the skew was making higher lows while the S&P was making lower lows here. All right. And so that was, another kind of a bullish indicator there that the stock market may be due for a bounce. Now, if we take a look here, we can see a big dramatic candlestick right here, right? Very bullish candlestick, but we're only seeing a slight uptick in the skew. So, that's one thing that says, hey, maybe we need to be a little bit cautious of this rally. All right. And maybe this rally is getting a little bit too ahead of itself, right? These are, going to be ways in measurements that you use to look at the market and make your analysis, right? Now we have defensive versus offensive here. And so the blue line is going to be your high beta stocks versus your low volatility stocks. These are ratios right here, all right, all four of these. And then we have the S&P 500 on the top. We have consumer discretionary versus staples. We have our credit spreads, and then we have biotech here at the bottom. The reason that this is defensive versus offensive, all right, high beta, low beta, if this is going up, the market is risk on. Basically, it's offensive. If this is going up, it's offensive. If this is going up, it's offensive. If this is going up, it's offensive, and vice versa, right? And what are we seeing here? Well, we are seeing, right, if we take a look at the recent tick, we're seeing a strong rally in the S&P 500, but we're seeing a weak uptick in the high beta, low volatility ratio. We're seeing a good uptick here in the discretionary and staples, a good uptick here in in credit spreads, and a nice uptick here in biotech, right? So what we would say out of this, all right, in analyzing this is we would say, hey, 4 out of 4 of these are in confluence, right? They're all going up. So it makes sense that we're seeing the stock market rally here. And oftentimes you'll get to these areas where, all right, you're seeing 2 out of 4 rally and 2 out of 4 drop. And so that's when you can say, hey, maybe the market's a little bit indecisive right now. Maybe it's not actually so offensive, right? And so we really want to see, if we want to see the market continue to be more offensive here, we actually want to see more of an uptick here in the high beta versus low volatility stocks. Okay, that's what we're looking for. The rest right here all have pretty good upticks. Now, why is biotech on here, you might question? Well, biotech is arguably one of the most risk-on asset classes or sectors of the S&P 500. Oftentimes, these biotech companies are profitless companies looking to invent some type of drug or get a patent, different things like that. That they can, capitalize on in the future. But at the current time, these companies are just really just bleeding money, developing whatever it is that they're trying to develop, whether it's a cure, drug, patent, et cetera. Right. So, when we look at defensive versus offensive, 4 out of 4 here, right? Market looks more offensive. Okay. Underneath the hood of the market. This is another one right here. And basically, this is just a little bit simpler. It's got the consumer discretionary versus staples right here in the middle, and then we got biotech here on the bottom. And what I want to show you guys here is that typically for the S&P 500 to make new highs, right? Because that's the big question right now is the S&P 500 going to make new highs at the end of the year? Well, typically you need to see your consumer discretionary versus staples break out of its downtrend, all right? And you need to see the biotech break out of its downtrend, right? Once those two things happen, that's typically when you start to see the market break out of its new highs, right? If we look at this time period here from the beginning of the year, basically through March, all right, we can see that the S&P 500 was in a downtrend, the discretionaries versus staples was in a downtrend, and biotech was in a downtrend. Now, biotech broke out first here of its downtrend, and then after we saw biotech break out, we saw the discretionary versus staples break out, and then third, last but not least, that's when we actually saw the S&P 500 break out of its recent highs. So that's what we want to see in the market for any potential of the S&P 500 to make new highs. Now, where are we at right now? Well, the S&P 500 is still in a downtrend, right? Biotech is still in a downtrend, but here consumer discretionaries versus staples have actually broken out. So we've got 1 now out of 2 breaking out, and we really want to see 2 out of 2 breakout if we are going to potentially take out the previous highs right around 4,600 on the S&P 500. Okay, so biotech really needs to catch up here. It's got a strong start, right? And we can see it's pushing up aggressively here, but overall, it's still in that trend of making lower highs, lower highs, lower highs, lower highs. And even if we rally, if we reject around that area, that's going to be continuing the downtrend of lower highs. So I think biotech is going to be, an important sector to keep an eye on throughout the rest of the year. You really want to see, in my opinion, some strong pushes, some strong movements to the upside to support any evidence for an end of year rally. Now, this is risk on versus risk off right here. So we've got a risk on ETF on the top, risk off ETF in the middle. And then we've got the S&P 500 here on the bottom. So your risk off ETF is basically going to be gold, U.S. Treasury bonds, the yen, utility staples, and then risk on is going to be things like copper, high yield bonds, the Aussie dollar, semiconductors, and high beta. We saw risk off breakout, right? We talked about that in the last video, that, it made a lot of sense that the market was, falling so much. We're seeing, the risk off ETF break out, right? And we're seeing it break out of its downtrend. The big question is now, will this be a failed breakout, a look above and fail, and this starts to head lower? And can the risk on ETF actually break out, right? So that's what we want to pay attention here for the bulls, right? For the bears, all right, you're going to look for this breakout retest and push higher, and you're going to look for this to reject this trend line area here. And also for us to reject the trend line here on the S&P 500. So this is a good way to, measure risk on versus risk off, AKA defensive versus offensive, like how we're just looking at through those other metrics and measurements. Now, what we have on top is the Dow Jones Industrials, in the middle, Dow Jones Transportation, and then the S&P 500 here on the bottom. And we're not going to dive too much into the Dow Transportation theory, but essentially it can be a leading indicator for the markets. All right. Now, what do we mean by that? Well, if we take a look here, right, the Dow Jones Transportation actually topped out before the Dow Jones Industrials and the S&P 500, right? We can see both of those topped out here and here. And again, the Dow Jones Transportation Index topped out before that, right? It also bottomed before the S&P 500. If we see here, the S&P 500 bottomed around here, Dow Jones Transportation bottomed around there. Okay. And most recently, the yellow line was our critical support here, right? Red was overhead resistance. Yellow line was critical support. And we can see again that the Dow Jones Transportation theory actually broke below its critical support levels before the S&P 500 and the Dow Jones Industrial. So, it's kind of a leading indicator that, hey, the Dow Jones Transportation is performing really badly, really poorly. That could be very bad for the rest of the market. And sure enough, that's what we saw. Now, if we take a look at what's happening right now, it's very close to breaking out, right? And all three of these are very close to breaking out of their recent downtrends. If we can get, basically what we want to see is we want to see this breakout. We want to see this breakout. But most importantly, we want to see this breakout, right? If this does not break out, but these two break out up top here and here, that could be an indicator of a false breakout and a look above and fail if we don't get confluence and don't get a nice breakout in the Dow Jones Transportation. So definitely want to keep an eye on that. Hopefully you guys enjoyed today's video. Don't forget to sign up for that newsletter, okay, giving out free valuable finance content as well as free trade ideas every single week. All right. You can always join the Discord, the Investment Intelligence Discord, using the link in the description. It's very affordable, right? Not looking to get rich off of you guys. It's only priced at around $10 a month. So it's a couple dollars a week. And, you get really good access to lots of great information, as well as some trade ideas. There's a bot in there. There's a stock bot in there you can pull valuable information from at any time. Don't forget to check out the Ko-Fi page as well. All right. You click on commissions here. You can book a 30-minute or 1-hour personal session. If you feel like you need that extra personal one-on-one touch, right? Maybe you want to, go through some of these things with me, right? But, you want to ask some questions, right? And a lot of people come at me also for options, like option strategies and learning about different option strategies, how you can hedge yourself with option strategies, different types of option plays, right? There's lots of different strategies that you can go about with options, versus just buying, going long and going short. It can get very complex. All right. You can also request a YouTube video on the specific topic of your choice here. That's where the viewer requests are being done now. So this way, we can kind of keep track and not get lost in the comments. And as I mentioned before, if you ever enjoy all of the free valuable content I do put out for you guys, you can click on this buy a coffee button, and that's basically a way to leave a tip or donation for the free content that I do put out for you guys. Thank you for watching. Smash the like button, subscribe for more.